Private markets enter 2026 with something to prove and a real chance to do it. This is the 2026 Private Markets Outlook podcast from Future Standard. The last few years have been a bumpy ride. Post-pandemic inflation triggered the most aggressive rate hike cycle in a generation, stalling deal activity as liquidity dried up. And meanwhile, public markets, powered by AI, kept ripping higher. Magnificent returns and a handful of companies set a nearly impossible bar for other asset classes to clear. So yes, private markets have something to prove, but there's real momentum brewing as we speak. The economy has proved both steady and dynamic, and as financing costs have come down, capital that had been sidelined is being put into motion. And maybe most importantly, the conversation on portfolios is changing. The AI trade that built enormous wealth is now injecting real volatility, making the risks from high valuations and concentration, which once felt theoretical, much more concrete. This brings about an inflection point. Here, now, in 2026, the opportunity set in private markets is broadening. Valuations in some parts are compelling relative to public markets. And the macro backdrop will provide an environment supportive of durable value creation. But there's a caveat, and this is important. This is not a beta market. It's not enough to allocate to private markets and hope for the best. RJ Nabisco, Yale's endowment, barbarians at the gates, great stories, but those along with the formula behind those returns, that's all in the past. We must adapt. Now, being specific in segment selection, manager differentiation, and deal structure matter more than ever. In this cycle, returns won't be discovered lying around. They'll have to be built through sourcing, specialization, and hands-on value creation. That's why we titled this year's Outlook, Forged, Not Found. Because in 2026 and the years ahead, value won't be given. It will be created. As always, I'm joined today by my esteemed colleague and leader in investment research, Senior Vice President Andrew Kors.
Alan, it's great to be here. I'm excited for this conversation.
Sounds great. Thanks, Andrew. And exciting for us. It's a new year. It's a new outlook. It's always outlook season, as you always say. And we're joining from a new office as well. Today's the first episode, joining from Future Standard's new global headquarters in Philadelphia's beautiful Schuylkill Yards.
Yeah, fancy new studio here. And we're officially in the second half of the 2020s, I realized. So, a good time to look back at what was a wild first half of the decade and look forward to what I imagine will be equally transformational second half of the 2020s.
Well, that's really what we're calling for in the piece is, really kind of a transformational time in private markets. And, there are a lot of factors that we'll get into in the conversation today. Today will be part one of our discussion on the 2026 Private Markets Outlook, which for those listening can be found in the show notes as well as at futurestandard.com/insights. And I think it's always helpful. We have long-term views. We're long-term investors. It's a long research piece.
It is.
I think it's always helpful to frame it out for folks, what to expect in the piece, how it's structured, and kind of make it approachable in terms of the thoughts that we lay out.
Sure. So first, as always, we sort of do deep dives into the three primary asset classes where we invest, which is private equity, private credit, and commercial real estate. But then I think the piece really, the goal is to sort of zoom out, right? And as you mentioned, we're long-term investors. What really matters here is not the sort of noise of sort of the everyday media storm, but really stepping back, understanding what matters and how to allocate based on that. You think about what we've witnessed just in the first 2 months of this year, right? The geopolitical news,
right?
The trade around the AI diffusion into the economy, obviously narratives flying around private credit, which we'll get into throughout this series. We really are in a media maelstrom right now, I think, right? And, with this outlook, I think fundamentally we're hoping to sort of help investors see the forest for the trees within private markets and ultimately help them pinpoint, okay, where are the opportunities within these markets? Where are the risks? And how do we sort of navigate our portfolios around that?
And one of the things that we build a lot of our insights around is what is that fundamental macro backdrop? Like, you've got to have the big things kind of understood and, on lock before you can kind of delve into how to apply this within a specific asset class and then ultimately building an investment allocation. And, part of the piece we set up is the macro backdrop, and there's kind of big macro, but then there's also middle market macro, which is the part of the market where we focus. And I think maybe explaining a little bit why we kind of segment between the two and what makes the middle market distinctly different in terms of the macro drivers there versus the broader economy.
Yeah, totally. So maybe to start real quick on, the broader macro backdrop, we also wrote a 2026 economic outlook that went out in early January. But, I would say from a cyclical standpoint, things look pretty healthy in the U.S. economy right now, right? So we came into the year, 2025, 2.2% real GDP growth. We just got Q4 data the other day. A slight slowdown from 2024, but still pretty healthy, right? I think the drivers were a little bit narrower, right? Where you had sort of the data center AI investment boom. You had consumption that's held up really well. But outside of that, there's been some weakness in other parts of the economy. As we come into this year, I think a lot of those supports remain, right? And then you build on top of that. You get more expansionary policy from the fiscal side with the One Big Beautiful Bill. We may get some more as sort of Republicans look forward to the midterms and maybe want to pass some incremental fiscal policy. You're going to get some lagged effects from easier monetary policy, which I think will start to come through in the first half of this year. We may get more cuts in the back half of this year. We'll see. And then I think one thing that people were a little bit concerned about coming into the year was labor market, right? And you look at some of the labor market data we've gotten in the first 2 months of 2026, it's really stabilized. Things look solid there. So I think when we look forward to this year, it should be another solid year for the economy with the potential for a little bit more, even if things, broaden out and sort of some of the macro factors I mentioned break the right way.
And when we look into the middle market specifically, we have a very close relationship with the National Center for the Middle Market at The Ohio State University. They do great research, and we're quick to read anything that they put out. And one of the things that's highlighted there is you have revenue growth there that remains very strong, kind of at or near double digits. But more broadly, it's a part of the economy that's different in its complexion than what we think of as certainly the broader global economy, but also, the composition of the stock market. Like, it's very unique and is a better mirror for what the real economy looks like in terms of the number of industrials companies, the number of healthcare companies, services-oriented firms that are not kind of the large global scaled players. And so, when we think about like how is the macro environment there in particular, as it relates to kind of the bigger picture, what are you seeing there in that part of the market? Yeah,
and we have a whole section on this in the piece. I would recommend folks go and read. But I think you make a good point. It's always important to look at different segments of the economy and understand how different macro factors are affecting different segments. But I think it's particularly important, specifically with the middle market in our discussion here. First of all, we like to think of the middle market as sort of the beating heart of the U.S. economy, right? You mentioned the National Center for the Middle Market. They do great research. One thing they do is help us quantify how big the middle market is. And, you look at it, you're talking about more than 200,000 companies in this part of the economy, right? Mid-sized companies may make up about a third of private sector GDP. They're very much domestically oriented. So as you mentioned, if we're trying to get a pulse on like what's going on in the U.S. economy outside of the hyperscalers and, the AI build out, this is a great place to get that. So that's sort of, number one. Secondly, I think with our discussion with private markets, right? Most of the deals that are happening in private equity, private credit are still in the middle market, right?
Well, over 90%.
Right. There's lots of dollars that are moving up market, and we'll talk about that in a bit. But from a sort of deal count standpoint, the vast majority of the deals are still happening in this part of the economy. And as a result, it's really important that we understand exactly what the macro factors that are impacting it are. And then finally, I think, I mentioned the cyclical backdrop, pretty benign. But there are also these secular factors, right? So if the cyclical looks stable, I think some of the secular factors that we've talked about, whether it's the technological revolution that is AI, whether it's, what's the term you called sort of this, the new trade regime,
Modern mercantilism.
Modern mercantilism. I think that's a really nice way to put it. But I think ultimately what it means is that countries are beginning to favor insularity and resilience over openness and efficiency. Right. So when you put all that together, right, I think those secular forces, which are sort of disrupting a lot of the long-held beliefs about how the global economy works, is sort of driving a wedge between what we consider like the middle market companies and called a large cap portion of the U.S. corporate environment. Right. So on the tech side, a lot of the AI build out, whether it's sort of the picks and shovels or the actual builders of the infrastructure, they're really over-indexed in a large part of the of the corporate corporate America, right? In the middle market, it's much more indexed towards the potential beneficiaries of AI, right? And then you think about it from a sort of deglobalization, resilience over efficiency standpoint. The large companies are the ones who were able to build out those complex supply chains across the world, right? They really benefited from that world. I think as we move into a more domestically oriented, resilience-oriented world, it sort of shifts the puck towards the middle market. So I think as we think about the differences, they may widen as these secular shifts that we talked about, come more to the fore.
Yeah, and it's a timely conversation. I mean, we're sitting here on February 25th, and we heard the State of the Union address last night, and the President Trump talked about 18 trillion, I think was the number that he said in terms of capital commitments for domestic investment. And whether it's that number or some number,
even if
that,
a tenth of that comes in,
ultimately that is kind of real foreign direct investment, capital investment into the U.S. economy to build up that capital stock and that base. And a lot of that investment would be happening in middle market companies that are domestically oriented, domestically resilient.
Yeah, and what I'd say is you look at the trends in middle market companies today. You mentioned revenue growth. 2025, 12% annual average revenue growth across middle market companies. That's really strong. You poll these executives, they're all very optimistic about the future. They're investing for growth, all those things. That's a positive. And then the one thing that we point out in the piece too is margins, right?
Sure.
Margins have been a little bit challenged for a few years as nominal growth came down, operating leverage sort of went into reverse. You stand here today, a lot of that's kind of come through. Nominal growth actually might be inflecting a bit higher, right? That's a positive for margins. One thing that's key to our outlook is productivity in the economy, which we've seen improve. That's like a fertilizer for margins, right? That's exactly what you want to see if you want to expand margins in the broader economy. And then AI is the X factor, right? So to the extent firms can efficiently and effectively implement AI, a lot of times with the help of private capital, that could help expand margins as well. So I think the outlook right now, as it stands today, is pretty stable with, I think, the potential for continued strengthening into 26 and beyond for middle market companies.
And so I'd like to pivot the conversation into focusing more on the defining trends. And the defining trends in our piece, the way I look at it is like, this is really kind of the trunk of the tree, from which a lot of things branch off into the various asset classes, which we'll cover more in our next episode when we specifically hone in on private equity, private credit, and real estate and the opportunities we see there. But in terms of the defining trends, we pull through, like we've talked about, the cyclical, the structural, and the secular. And so the cyclical is so important, like we've talked about. It's, what's the current setup? What's attractive today? What's the risk before you? If you're good with that, that gives you a backdrop to then address the next layer of risk within a portfolio, which is that structural. How, in what way is the market, shifting in the way in which it operates and the opportunity set that's coming from longer term themes that are playing out, and what implications does that have? And then you can get to the secular, the very long term. And this is, we've been going back and forth on it already, the long-term enduring trends that are here to stay, recognize it, reconcile it, and plan for it in your allocation decisions. And, of course, chief among those today is the impact of AI and the growth of that sector. And so when we think about, defining trends that we pull through, a cyclical rebound with a twist is what we call it. And, what is changing? What is driving that? What do we mean when we say cyclical rebound, but with a twist? What is the twist?
That's the question, right? So look, I think it's been a tough 3.5 years in private markets, right?
Mm-hmm.
Rates went up, liquidity dried up, deal activity went away for a while. What we're seeing at the beginning of this year, we saw it begin in the second half of 2025, but I think, we're sort of seeing the momentum build early this year is a cyclical rebound in deal activity, right? That's consistent with something resembling an early cycle environment, right? Generally speaking, you come out of some sort of drawdown,
Right.
deal activity is depressed, and then you ride the wave up. The twist is that valuations are certainly not early cycle, right? If anything, I would say they're mid-cycle, even in some parts of the market, looking late cycle. I know you like to say. But, I think bottom line, you think about PE multiples anywhere from, call it 11, 12 in the middle market to 15, 16, 17 in the upper end of the market. You think about credit spreads, pretty tight across public and private credit.
Pretty tight.
You think about real estate, cap rates have come up, but not nearly as much as financing costs have come up, right? So that gap that equity holders can exploit is historically tight right now. So, you put that all together, right? And, normally early in a cycle, what you can do is basically arbitrage the uncertainty, right? There's sort of a recovering economy. There's a recovering capital markets complex.
Right.
And by sort of deploying capital into that early cycle environment, you can take advantage of depressed valuations and sort of ride that beta up, right? That is not available in this market, right? There's still a lot of economic optimism out there. Again, valuations are pretty full across most asset classes. So, the good news is that opportunities are broadening and growing. There's a lot more opportunities to do deals, interesting deals. There's more liquidity in the market. There's more certainty around valuation. But I think investors are ultimately going to have to be selective and specific with the segments of the market where they're sort of accessing and the managers that they're using to access that.
Yeah, and something else that's different here too is, you're kind of starting with the early cycle momentum with rates still relatively elevated relative to where they were in the past. I mean, you're not, there is more of a kind of implicit cost of investment today where you're foregoing, risk-free rate that's still pretty attractive on a historical basis versus, early cycle last go around coming out of the GFC when, money was free and why not take risk? And every incentive was driving you to take risk. The incentives from the Fed are still sort of telling you not to take risk, yet the market wants to take risk.
Yeah, no,
that's the betwixt position that we're in.
And the Fed doesn't want to let that get away too much, right? So the bottom line is we didn't have a recession, right?
Yep.
And because of that, because fundamentals stayed strong, private asset managers were able to hold on to assets instead of marking them down and fire selling them. They weren't forced to sell.
Right.
And as a result, you didn't have the type of correction that you might have seen if you had a recession. The other side of that is you come out the other side and there's not this massive valuation opportunity, right? So it's sort of a function of the macro environment and the fact that we have had, can I say it, a soft landing through now.
Yeah.
But it does set up this very unique investment landscape that we're not quite used to.
Yeah. So now that we have a cyclical backdrop, that we're comfortable that there's some momentum gaining, even though it's a little bit different this go around, we take that next step. What are the structural factors that are sort of reshaping markets? And, I think we've talked about this before. Capital concentration in private markets is really at an all-time high. It's quite staggering when you look at it. Folks talk about wealth concentration quite a lot, but in terms of in the asset management business in the private markets, there's a concentration there as well too. And we have a stat in the outlook that the top 1% of managers have nearly 50% of global private capital at AUM. That they are the authors of, and that's just 24 firms across the globe.
Yeah.
You think about even like the banking sector. People think about the banking sector as being extremely concentrated. Well, when you put it on a global basis, it's not as concentrated perhaps as what private capital is. And so when you think about how these firms go about allocating to the markets, the types of deals that they're looking for, and also the evolution of private capital markets that's led to conditions that are kind of facilitating the concentration, it does change what's more attractive today and certainly what's more competitive in terms of deals that you're looking to do.
Yeah, I think that's exactly right. And I think your last point there I want to pick up on. I think it's really important that people recognize that like the private markets landscape is very different today than it was 10 or even 5 years ago, right? The scaled players have gotten so much bigger over the past 5 to 10 years. You think about the funds that are being raised, right? $25, $30 billion funds. We have an analysis in the private equity section of the paper that shows that the 17 largest buyout funds ever raised have been raised since 2020, right? And you look at how much money in dry powder they still have to deploy within those funds, it's like $230 billion, right? Which is going to require close to $500 billion in deal flow just to put that money to work over the next couple of years, right? So just a massive, to your point, concentration of investor capital flowing to these select few managers. And, you know, it's like, okay, like, you know, these guys do a good job. Part of it actually is we think, you know, this period of sort of challenge for private markets, we call it the quality mirage, right? People see brand names. Maybe they want to sort of narrow the number of managers they're allocating to. They see somebody where they can go allocate a bunch of money here and across asset classes. And it just makes things operationally more efficient. But this, call it quite flight to quality, right? It does have real impacts for investors, right? So number one, again, it's creating larger funds who are having to deploy that capital at scale. And you think about, okay, why does that matter, right? When you need to deploy capital at scale, number one, it narrows the opportunity set, right? There are just fewer assets of the size that it would make sense for these funds to spend their time doing the due diligence, executing the deal, et cetera, right? So there are just fewer assets out there that it makes sense for these funds to deploy into. When that's the case, there's more competition, right? There's less inefficiencies to exploit. And ultimately, we think like inefficiency is why private markets have been able to drive alpha throughout the years in the first place, right? And secondly, it pushes you into beta, right? So, you know, we've talked about this. You look at almost half of the dollars deployed into billion-dollar plus buyouts over the past 5 years. Almost half has been take privates, right? Taking public companies private. Is that really why you're buying private equity?
Yeah.
I don't know. And then, you know, you and I were just discussing this before the show. I mean, when you're raising money at that scale, there are only a few opportunities to deploy that much money, right? And right now, what is the most capital hungry thing in the economy?
Ding, ding, ding.
It's AI, right? And, you know, there are only so many deals to be done at that size. So you're almost forced when you have that much capital to go into, you know, whether it's real estate doing these data center deals, whether it's, you know, private equity or VC sort of funding these labs, right? Whether it's private credit funding the data center build-outs, you're seeing it metastasize across the economy, and these larger managers are almost being forced to take that flow, right?
And it's because private markets are an on-the-run market. Like, yes, there is a secondary market that's continuing to grow, and you can potentially get some liquidity on some older holdings, but the vast majority of the market is still an on-the-run market. What you can deploy into and buy today is what is coming to market. What is coming to market? Again, it's AI. So you don't have any option for new capital that's being raised and deployed, but to resemble the composition of the deal flow that's coming to market, unless you are of a size where you can be more selective. But again, when you're one of the 24 managers, you know, in the 1% that control nearly 50% of global private capital AUM, your ability to avoid being anything but what the market is bringing to you, as opposed to what you want to get from the market, to express a view in the market in your own deployment, it's just not as feasible. It's very challenging.
It's really hard to differentiate in that type of environment. So, you know, ultimately, what is this doing to the market? It's warping it in some ways, right? It's stretching it out. It's broadening the gap between what we consider like the bread and butter of private markets, which is middle market, versus the larger end, right? It's driving more competition, higher valuations, less selectivity at the top end of the market, where you look at the middle market and a lot of the same rules still apply, right? There's inefficiencies to take advantage of. There's ability to add an edge with sourcing, underwriting, you know, operational value creation, all those things that have historically not just private equity, but across the board, right, have been an edge and have ultimately been what's allowed managers to drive alpha over the long term. They still exist there, but it's just that, again, this concentration and this scale is sort of warping markets in a way that I think investors really need to pay attention to.
And so this concentration is happening when that flow that's coming to that capital is a lot of the same flavor. Our third defining trend is AI is eating the world. I kind of like this. It's fun to it's kind of an expressive way to put the problem. It's very dramatic. I think those of us that have seen, long-term predictions for the ultimate outcomes of AI are used to some draconian language when it comes to speaking about what the future looks like here.
The doomerism has really ramped up over the past couple months.
It has. And, it's not beneath us to engage in a little bit of doomerism.
No.
But, AI is eating the world. I think, ultimately what it means is everything is, I don't want to say infected, that's got a negative connotation, but everything, AI is inserting itself across asset classes in every which way, certainly in terms of the new deal flow that's coming in. But I think also how it plays in the sandbox with previously favored themes coming out of the software sector, the software as a service business models, some of them being challenged as well too. First, maybe we talk about what it means that so much of the deals are coming from new issuance that's coming to the market. It's coming from hyperscalers. It's coming to fund the AI build out. Talk about the scale of that and what it means for how capital markets look today versus what they'll look like 5 years from now.
You mentioned the disruption story that sort of gained traction this year. It's interesting that I think for 3 years, right, since ChatGPT's launch through like the end of last year, the markets were really only willing to entertain the upside of AI, right? And I think now it's like, oh shoot, like if AI is this transformational such that it deserves to add tens and tens of trillions of dollars of wealth, there's probably going to be business models that are get disrupted, right? And we're starting to see AI giveth and AI taketh away.
I mean, we were having these conversations a year ago. Well, I mean, we're looking at the valuations that are up of at the time it was public equity AI related themes. And they're all up and to the right. And then you look at the software sector, and at that time, it was still all up and to the right as well, too. And you and I are looking at each other across the desk going, something's got to give here. Your AI is not as great as what it's saying, and it's not going to cannibalize the software industry, or software is way overvalued because the thing that is...
We were sort of having our cake and eating it, too.
Exactly.
In a certain sense. But we'll probably continue to see that throughout this year, I think. But look, I think AI is simultaneously a tech story, it's an economic story, and it's a capital market story, right? So on the tech, look, we're not going to sit here and pretend like even the creators of AI have no idea what they're creating. Right. That's the crazy thing, right? So I think any attempt to predict what the tech is going to look like in 1, 2, or 3 years is probably beyond us. I will say that like the smart people that I follow in the space generally think things are accelerating right now from a sort of capability standpoint, which is interesting. And I think is sort of what's forcing some of the market moves that we've seen. Economically, on one end, there's the build out, right? We have a chart in our upcoming piece. The hyperscalers, if you combine CapEx and R&D spending, are going to spend close to $1 trillion in not just AI build out, but
energy and water, and fiber,
all those things.
Everything that goes into
that's equal to the GDP of Poland.
Right.
Like we're 5 companies are spending the GDP of Poland in 1 year. It's just remarkable. So there's that side, but then there's also the productivity side, right? We think certainly we're going to start to see. We're already seeing productivity improvements in the economy. How much of that's AI related is to be debated. I do think we're confident that as the years roll on, you're going to see AI sort of allow workers to create more, right, per unit of time.
Feeding into robotics and autonomous driving and, the whole nine.
Yeah, and then there's the labor market, which, we won't get into too much. But again, lots of uncertainty around the types of jobs it might displace versus the types of jobs that it might create. And then you mentioned the capital markets, right? And what sort of began as a confined equity market story, right? Whether it's the hyperscalers, the semiconductor companies in public markets, or like the private labs, the Anthropics, the OpenAIs, et cetera. What sort of began as an equity market story has sort of like escaped into the rest of the capital markets, right? Which when you have something that requires this much capital, it's just inevitable that that happens eventually. And you're seeing that, investment grade bond issuance, you're seeing the hyperscalers going there. You're seeing it in, real assets, real estate, infrastructure. You're seeing it certainly in private credit, and, in VC and even buyout as well. So you're seeing AI sort of metastasize across asset classes. And, what does that mean? It means there's going to be more correlation between these asset classes based on the performance of and sort of outcomes of the AI cycle, right? There's just no way around that. So I think as we look at it, private markets offer a way to address what I think is the most important investor consideration today, which is like, how do you get exposures that are either exposed differently to AI or sort of divorced from the theme entirely, right? And I think, what we talk about in the paper is that there are parts of private markets that really, really allow you to do that in a way that public markets are not right now. But again, you need to be selective and you need to be specific about which segments you're accessing.
Yeah, I think an old saw that investors use is like, don't be part of the gold rush, be part of like the shovels and rakes. I think it's a different analogy for the AI trade. I mean, the shovels and rakes is already sort of fully baked in. The way we break it down instead is you have the AI builders, which would be maybe your gold miners plus your shovels and rakes, versus the AI beneficiaries. And those are the firms that really reap the productivity gains without the upfront CapEx, without the monetization risk, the risk of monetization timing as well as much of a part of that risk.
And the use of AI is getting cheaper, actually, right? So you can deploy this stuff very cheaply and potentially get some pretty big gains out of it.
Yeah. So I think a better analogy than the gold rush is almost more like the building of the railroads. Like, was it the railroad companies themselves who really boomed when the railroads were built? Not totally. Was it the banks that financed the railroads? Well, no, we had a series of financial crises, kind of one after another right around the turn of the 19th century. And the firms that really benefited from the railroads being created were those that needed to ship heavy things. It was the coal industry, it was the steel industry, eventually the auto industry. So it was the beneficiaries, those that got to use the efficiency that was generated by the technology, in this case, the infrastructure and the technology, to bring their product to market faster, cheaper, better than what they could before.
Yeah, and this is where specialization becomes so, and deep, technical expertise becomes important, because you need to differentiate, that's all great. You need to differentiate between who's going to be a beneficiary and who's going to get disrupted, right? That's the game here that the market's playing. And the managers who do that right, who can say, hey, this company provides a product that's truly unique that we can enhance with AI, versus this industry is at serious risk of getting disrupted by AI native players. Very different. That's where a lot of the dispersion, I think, is going to come in.
And that's where, when you can get something that's not doubling down on this theme, which is so concentrated and relied upon across capital markets, the value of anything that accomplishes an investor objective that is not tied to that same theme, the value of that has just now gone up. I've gotten to use my favorite hand signal during the podcast now, but
we got this far.
We got this far. I had to get it in at some point. We speak to advisors and to the sales team and others around the firm. Educational work with folks on the markets, and I've adapted this as my new favorite hand signal.
This is probably exhilarating podcasting for people in the audio medium right now.
Well, it's a good reason to check out the YouTube version of the video.
You go.
So these defining trends ultimately set up priorities for, okay, now that I know what is shaping markets, where do I focus? What are the things that I need to be thinking about as I take this knowledge and look to make it more tangible? And one of the first things we talk about in the piece is the need to diversify the public equity concentration. An obvious and simple place for people to start. Public equities comprise, typically 90% plus of the risk within any investor's portfolio. That's the whole thesis behind the risk parity approach. But, it's even more pressing today now that some of that same theme is leaking out into the other asset classes. It would be really curious to kind of get your perspective, Andrew, on what are some of the chief ways to address that risk for investors? It's hard to escape. but kind of where do you go to address that more acute risk in public equities?
Yeah, and I think we've kind of talked around this theme a lot today. Look, AI exposed companies, I think conservatively make up close to half of the S&P 500, right? It's created tremendous gains. You can be the biggest AI optimist in the world, and I think still recognize that, because of that run up in asset prices, that theme now sort of makes up a very substantial part of your portfolio, right? The challenges in public markets, as you mentioned, whether it's public credit, certainly within the public equity markets, it's really hard to find areas that are not going to trade alongside that theme, right? So when we look in private markets, a similar sort of actually industry composition plagues the upper end of the market, right? A lot of those deals are in the tech sector, specifically in software, which we've seen has come under some challenge recently. So again, when we look at the middle market, it's much less tech exposed. It's much more, B2B companies, industrials, healthcare, some consumer. It reflects the U.S. economy in a much more direct way than sort of the more financialized large part of the market does.
And when pursuing, those sorts of opportunities that you just described, we talk about favoring smaller, more fragmented markets. The ways I describe it is making sure that your private assets are still private. How private is your private credit? How private is your private equity? Is it, sort of a hybridized, approach where, it's similar return drivers, similar risk drivers, terms and pricing are being kind of dictated by what's happening in public markets? Or is this something truly differentiated? Is this something where hands-on active ownership is what's driving the performance, or, the economic profile of the company and their ability to improve operations over time? Or is it, again, kind of like a beta play, which is fine. It has a role and, can be part of a portfolio. But if you're looking to differentiate and sort of replicate the past performance, within some of these markets, we think you've got to get a little bit more tactical and favor that smaller, more fragmented part of the market.
All capital markets, or I should say risk assets, did quite well from, call it 2010 to 2021, based on not only based on financial repression, but in significant part due to financial repression, right? We saw valuations glide up for a decade straight. That's true in both public and private markets. And private equity specifically, you look at like just the average amount of leverage used plus the increase in sort of beta valuation, right? Market valuations, accounted for about, close to half of the value creation in the average buyout, right? Similar thing in real estate where you saw cap rates just glide down for, a decade straight. That created quite strong returns that we don't think can be really replicated in the same way in this next cycle, right? So when we look at it across asset classes, you're going to need to add value, whether it's at sourcing, finding unique deals with better entry points, whether it's in underwriting, you see something in a company or in an asset that somebody else doesn't. And most importantly, I think in operational value creation, right? Where you come into the company, you professionalize management, right? You introduce new product, you enter new markets. One of the things we focus on in the piece is upgrading the tech, right? And AI is a huge part of that. I think, the challenge will be picking managers who are really good at that. And I think that's when investors need to dig in and be like, okay, what is your, what does your return history look like? Not only what is the headline returns, but like, how were they driven? Right. And I think the positive about this environment though, is that the levers for that value creation, right? That hands-on, taking a company from good to great, taking an asset from good to great, the opportunities, the levers for that have really never been better, right? You've got all the technology at your fingertips. You've got this amazing new AI tool that you can bring in and, improve productivity, hopefully expand margins. So, our view is not that you're going to have to accept lower returns because valuations are, starting valuations are where they are. Our view is that the buildup of return is going to change, and your ability to access that return means you're going to have to be very specific about what segments you get into. And
what you've been kind of talking about here at the tail end here is, the key priority number 3, which is the need to prioritize specialization and the operational edge.
Yeah.
It is that hands-on ownership, like going in and doing the hard work, which by the way takes time, takes like committed people, takes people that know industries, know specific on the ground factors, know how to deal in, highly regulated environments at times, have the, a varied skill set. It's not just the folks that can understand, the discounted cash flows and the IRR behind a certain financial transaction.
Yeah.
Like these are operators that know, how to run a warehousing logistics business, a manufacturer, a sports lighting company, the people that know like the number of LED foot candle light bulbs, that it takes at a football stadium for a sporting event. So, it is a different type of investor that has a real firm grasp of what it is that they're actually trying to drive from a business perspective. And as a result, the returns then follow.
Yeah, and I think like if we think about the last cycle again, multiple expansion, low rates, that favored generalists, right? Because it was a rising tide that lifted all boats.
Yep.
If you could sort of be dynamic and look around for it's like, hey, we do all types of deals. That was great.
Cheap beta is the ultimate generalist approach.
Yes, and it worked.
Yeah.
You can be a generalist in this market, but the generalists are going to be at a significant disadvantage to specialized players who have deep understanding and knowledge and relationships in a specific industry or segment, or using a specific type of value creation technique, whatever it might be. So I think again, generalists favor sort of the scaled players. This sort of specialized operational edge, niche approach very much favors the less scaled, as we've talked about, sort of middle market parts of these asset classes.
Yeah, and really where you create your own destiny.
Yep.
And part of that is creating your own deal flow, sourcing your own deal flow, having it be different, unique, and having it be in places where you have an edge.
Yep.
And it's hard to have an edge in the largest private companies where everybody knows what it is. It's not a secret. Like calling it private equity is really just, it's still owned outside the stock market. There's not that much private about like OpenAI and like XAI and that sort of thing at this point. So it really is kind of getting off the beaten path and returning to what private equity has been in the past, right? Which is you go out, you find a company that's off the beaten path that not a ton of people necessarily know about. You provide a capital solution to them that works for the owners, the founders, the executive team. You come in as a partner, you work together, you improve that company, you make it bigger and better, and you exit that company a few years down the line when it's a higher performing, higher margin, more stable and profitable business. Return the money back to shareholders.
The markets have gotten stretched in a way that forces investors to be active, to take an active role in sort of selecting to their segments.
So, Andrew, I'd like to kind of do a bit of a full recap of our conversation thus far, if I may. So, we started the conversation, really the economy is on solid footing. Growth is especially robust in the U.S. middle market. Deal momentum's building in private markets, but there are complicating factors. Valuations never reset, and one central theme dominates, and it's a theme that's directly challenging the theme that had dominated for the prior decade plus, and currently sits as the largest industry exposure in both private equity and private credit. And meanwhile, in the background, we have capital concentration increasing, which is reshaping market composition, competing for deals as opposed to, matching an issuer's need with a capital solution. And it's causing somewhat of a blurring of the lines between public markets and the top end of private markets, which shapes outcomes and opportunities and how valuable that is in a portfolio. Where it's like, is it private equity because the GP is leveraging its control position to drive operational improvement and completing the market with opportunities not readily available in public markets or accessing better valuations? Or is it private equity or private credit just because the asset's held in an illiquid wrapper?
Right.
There should be a reason for the asset to be held in that wrapper, and it's because real valuation takes time. And so, we started this conversation by saying that private markets have something to prove in 2026. I think that value proposition is exactly what it needs to prove. And it's not going to necessarily do it by, continuing down the path of hybridizing with public markets and not being what private assets are supposed to be for investors.
Yeah.
And that's really why we think that we're at an inflection point. There are many sort of career defining, as it seems. It's hard to know when you're in one of those moments.
Feels like one.
But it does feel like one of those big kind of career defining developments underway for investors and allocators right now. And, the past is a guide, but it's not a plan. And it certainly doesn't seem like doing what worked previously will work going forward. So we're sitting here and we have to ask ourselves, well, what is the solution? How do investors adapt their approach in order to maximize the benefits of a private markets allocation with this inflection point now upon us? What are kind of the main takeaways that folks should think about and take back when they're considering their private markets allocations?
Yeah, so I think three things. Number one, you mentioned in your intro and there in your summary, private markets have something to prove. And I do think that is partially true. I also think the private markets have proven it over multiple cycles, right, in multiple different macro regimes, that they add value to portfolios, right? These are not new markets necessarily, right? They've been around for decades in a lot of cases. I think the reality is, yes, private markets have gone through a challenging three and a half years since the Fed started raising rates, which I think has been brought into more contrast because public equities have done so well, right? Like the S&P 500's taken off since the end of 2022, in large part because you've had this sort of out of nowhere AI boom that nobody really expected until they started playing with ChatGPT and they were like, oh my God, this is incredible, right? So you've had these sort of two things juxtaposed and it's really highlighted the challenges in private markets over that period. And what I keep coming back to is this, right? Private markets have proven over multiple cycles, again, over multiple different macro regimes, that they deliver value. The model works, right? That's been proven. Or the model can work.
Yes.
Right?
Good one.
And on top of that, I think generally speaking, you think about what have the best times been to invest in private markets, right? Is it when everybody agrees that private markets are great? No, it's not. It's when people are unsure, right? People are skeptical. That's built into sort of market activity valuations, whatever you want to call it. And then over time, that business model reasserts itself, right? And you get the types of returns that you're expecting, right? So you think about like when everybody was sure that private credit and private equity were the best things since sliced bread, it was sort of late 2020 through early 22.
Yeah.
Do you expect those to be like great vintages? No. So look, there's always uncertainty in investing. I think as long-term investors, our job is to help see through like the short-term uncertainty and take advantage of the opportunities that uncertainty brings, while also, as we've talked about in this discussion, paying attention to like the secular themes that are going to drive returns going forward, right? Yeah. The second thing, we talked about leaning into specialization, right? This is not a generalist market.
Right.
This is a specialist market, right? In the last cycle, the macro like kind of was the value creation plan, right? Like low rates, leverage, valuation expansion was sort of the value creation thesis. Today, I like to say that that's shifted to like the macro is providing the tools to create value in your assets and your portfolio companies, right? The economy is good. It's better than it was during most of the 2010s, right? You've got this incredible new technology. Like you've got all these things that are giving you the tools, but not everybody's going to be able to do it, right? And then the third thing is pursuing true diversification, right? We've talked about the concentration in public equity markets and the AI theme. We've talked about the concentration in private markets at sort of these very, very large scaled platform managers. Finding ways to diversify your portfolio, both on a manager basis within private markets and on a theme and sector basis within public markets is absolutely crucial. You don't need diversification until you need it.
Yeah.
And I think investors, given what's going on in markets to start this year, are beginning to understand how important that is. So those are really the three takeaways that I would leave listeners with.
Yeah, I mean, on the diversification point, I think, something I've been saying lately is like, don't do diversification in name only. And, what that's really meant to mean is don't just trade one manager for another within the same market segment. You've diversified, obviously, the idiosyncratic risk of the manager, but you haven't diversified the fundamental return drivers of the assets that those managers are going to be purchasing on your behalf. You need to look through to the market segment and the return drivers within those segments, be it more of a financialized source of risk, be it more of an operational source of risk, and ultimately kind of think from a total portfolio approach around some of these key themes. How much AI do you have in your portfolio? That's not a question just for your public equity book. It's not a question just for your private equity book. That's a question now for your entire portfolio. Yeah. As is the question around how much do you have exposed to AI disruption? That's a total portfolio question now. And that challenges a little bit of the in-name only diversification that you've historically realized on, at an asset class kind of bucketing approach level.
Yeah.
And so it requires, again, all this goes back to a new playbook, reasons to adapt and move forward in how folks approach their private markets allocations.
And this is forged, not found. Right.
Right.
That's the title of our outlook. And that's both the call to action to managers and to investors, right? Mm-hmm. On the manager side, it's going to, you're going to have to, when you buy an asset, when you buy a company, when you lend to a company, you're going to have to do the work, right? Again, the macro is not going to do the work for you. You're going to have to go in, improve the asset, roll your sleeves up, add value from an operational perspective. That's how you're going to drive returns. And then from an end client perspective, beta to private markets has become efficient at this point, right? That's the bottom line. And if you're looking to get out of private markets what you got in the last cycle, it's going to take a much more active approach in understanding, again, how those returns are going to be driven and where within private markets, both from a manager standpoint and a segment standpoint, are you most likely to be able to extract that type of alpha? So, forged, not found. Really excited to get this report out there, Alan, and it's been great summarizing it with you here today.
No, really enjoyed it, Andrew, and we'll continue to lean into these themes and pull through, that need for specialization and diversification into asset class by asset class, private equity, private credit, real estate, in the next episode of the podcast. But if you don't want to wait until then, you can go right to the website today, futurestandard.com/insights, and look for the Outlook Forged Not Found, or check the link in the show notes. Hope you will. Hope you enjoyed today's episode. And Andrew, really enjoyed our conversation. Good to get back in the studio with you.
Alan, it's been great. The new studio is fantastic. Excited to start getting more episodes out.
Great year ahead. Thanks, Andrew.
That's right.